Welcome to the Daily Update. This is Being Prepared Friday, August 26th, where we'll look at the action in the market today and then see how things look for Monday, August 29th. Gee, do you think the market didn't really like what Fed Chair Powell said? Yeah, they didn't like what he said. It looks like the scenario is now going back from, gee, we think inflation has topped out and is going to go lower, and so the Fed is going to turn more dovish. It looks like that's not happening. They are totally committed at the Fed to getting a control of inflation, getting it under control, trying to get it back down to 2%. And that really spooked the market. Now, this is the second time this has happened. You remember a month or so back, a couple months back now, where this scenario started to develop that maybe inflation has topped out. We're starting to come back down. We got spooked out by that. This is number two, okay? Should be once bitten, twice shy, but is this going to develop again? And I have to cough. So things were decidedly negative. They started off a little apprehensive, and then once we started heading lower, they just went to the races lower. So what can we say about what happened on Friday? We did have a slightly lower open, but prices quickly fell below S1, and this should be S2 over here, 41.29. We went down, and we went down fast. As the day went on, we actually went all the way down to S3 at 40.77 and even went below that. So going into the close, we actually closed at the low for the session. We ended up being down 3.37%. Volume, although it did pick up, was still below average overall. Technicals, they've switched over negative now. You can't really read anything else into it. I know there's people buy the dip, but you don't want to get in front of a moving freight train or try to catch a falling knife. That's my philosophy on things. What worked in 2020 and 2021 doesn't seem to really be working right now. We need more confirmation that things are going to turn and go in the desired direction before we actually take on at least long positions right now, because that's the path of most resistance for 2022. The markets are still fixated on inflation and interest rates. We still have the geopolitical concerns, which aren't really impacting the market right now. But again, that always could change. Earnings reports are coming out. We've got the debate going back and forth about what is a recession and are we in one. The Fed speak, that's in gold because that's the fixation. Now, we had the reaction to it on Friday. Folks are going to go home over the weekend, read some articles, watch some YouTube videos, listen to their favorite gurus or people that they look to for information, and we'll have to see, is this going to continue into Monday's session? There are some charts that suggest that we probably overdid it, at least in Friday's session. You don't have 3 1/3% declines without it really, we don't usually see those kinds of moves. And so, yes, we did overdo it by some indications. So what are some comments? They did not like what Fed Chair Powell said. And that set the whole tone for the day. Our rotation and positive setups, they're going off to the back burner again because they're starting to show some weakness. The 10 to the 2 and the 10 to the 5, they're still inverted. We're seeing a real strong inverse correlation right now between interest rates, the dollar, and oil and stocks. They're going in opposite directions from each other. So that is actually helpful for us because while the market's open, we can watch these other markets to see what are they doing. And that might either add some support or some follow through weakness to stocks. Fear is starting to increase. We did have personal income that came out. It was 0.2% on a month over month basis, where they expected that to be higher at 0.6. So that means people are bringing in less money. Personal spending, it didn't go up as much as they had feared. They thought it was going to be up 0.4%. It ended up being up 0.1%. And then the price index, it was down 0.1% on a month over month basis, where they expected it to be up 0.1%. This translates over into a 6.3% year over year basis, where last month when this report came out, we were at a 6.8% basis. So this is showing that maybe inflation is starting to tame down a little bit. When you take out food and energy, we were up 0.1%. They expected it to be up even higher than that at 0.3%, or this translates over into a 4.6% year over year, where we saw 4.8% in June. So it's coming down a little bit. If Chairperson Powell had said, well, yeah, things are looking a little better, we might look to be able to start at least slowing down our rate hikes pretty soon. Based on this data and other economic reports that we've been seeing, we would have shot to the moon. But that's not what happened on Friday. We also saw a bit of a tick up with consumer sentiment. The final reading came in at 58.2. They expected it to be about at what it was 2 weeks ago at 55.1 when they came out with the preliminary report. Just to get you some perspective, a year ago, sentiment was at 70.3, which is still not all that high, but compared to where it is right now, that seems like so long ago. Just think where it will be a year from now. We'll have to see. Hopefully it'll be a lot higher. The trend has switched over to negative. The ADX, the lines have crossed, and I'll show you that chart, but it's still weakening overall. Our bias is negative and our momentum is also negative. So let's go back and look at this. We've dropped out of neutral territory and we're slightly into the fear camp right now. We're seeing a bit of a spike up in the bearish mutual funds that some folks use, but not necessarily an extreme reading. This could go a lot higher if the market still continues to fall before we use this as a contrary indicator. Active asset managers. Now remember, all these charts that I'm showing you, they came out before Friday's session. We saw a bit of a decline with those folks willing to take on more risk. This will probably go down quite a bit more in next week's reading. Here's the consumer sentiment showing how it bounced up a little bit. We're still seeing a really wide spread between the 2-year treasury yield and how people feel about things. That's what this measures down below, even though it did decrease slightly. These tend to move in the same direction and they tend to not get all that far apart from each other. They still are quite far apart, but it's showing some improvement. This is just suggesting that the dollar could be overvalued. I use the USD dollar index, which has been around for a long time. There's another dollar index called the DXY, and this is suggesting that the dollar is overextended to the upside. Also, looking at the forecast and our forwards. Now, I'm not a gold expert, okay? And I never claim to be one. But if you listen to folks that are really into gold, no matter what happens, they put a positive slant on it. These same folks, and unfortunately, and I don't mean to insult anybody, if you use Elliott Wave, they've been predicting doom and gloom for 20 plus years now. At least the couple of folks that I kind of follow a little bit, they tend to be very negative about things. They're drawing straight down lines for stocks and straight up lines for gold, and they've been exactly wrong for about 20 years now. Now, eventually, if they keep saying the same thing over and over, they'll be right, but they don't have a very good track record with this. Bank of America is really expecting gold to jump up, and the forward-looking line right here is also expecting gold to show some increase, but it's just not been behaving all that well. It was down in Friday's session as well, and under these types of conditions, you'd think gold would go up, but it's not. This is kind of interesting. We were looking at some studies showing, comparing the first half with the second half when we have midterm years, and if we have a really strong down first half, the second half looks better. Well, we kind of threw that away, and now we're looking at the first 2/3 of the year, saying that things could get bumpy for quite a while before they might turn better going into the last part of the year. I don't use these charts to make decisions. They're just kind of interesting to look at because sometimes this happens and sometimes it doesn't. And we just have to take things more on a day in and day out basis. That's my philosophy on things. This is showing how emerging markets, when you compare it to the dollar, they have been really underperforming. And then this is showing the number of days that we have gone without the S&P getting to a new all-time high. Not necessarily an extreme reading right now compared to 2000 going into 2007, then 2008 into 2013, and so forth. Again, I don't know if this is really all that helpful, but it's statistical things that people get paid to sit around in offices and crunch these numbers. This is one thing that we do want to keep an eye on. One of the big debates is we're not in a recession because the employment situation is so good. We're still seeing a real trailing off in jobless claims. If we are going to go into a pretty severe recession, no matter how you define it, we're going to see this blue line really start to move up. And it really hasn't done that yet, especially when compared to recent years. This is showing the real S&P 500 index. That's when you take inflation into consideration. And then you compare it with valuations. A lot of this data is on Robert Shiller, somebody that I respect and recommend that you read his books. I use some of his charts. This is showing how we've been going up with the S&P based on inflation and now have been coming down, where we have the cyclically adjusted PE ratio. That looks back, okay? It's not really forward looking, but it's really been coming down as well. So it's still suggesting that the market is overvalued. And I deal with this more in the weekly and intermarket analysis charts that I'll prepare over the weekend. Let's look at our different sector rotation. Growth got hit across the board, down over 4% with the large caps. Because it was such a down day, the VIX really spiked up, both with the bar chart and the line chart. The VIX of the VIX, which measures how fast the VIX moves, that spiked up as well. The Elser index is actually becoming a little more relevant now. We're kind of in the middle as far as our fear and greed index, and we're coming back up to the moving average right now. So the daily chart is now a little bit more realistic compared to what we're seeing. Here's the weekly chart where it's just kind of been floating sideways, but this had been helpful to us for quite some time. We're down 15.79% from the all-time high. The equity put call ratio, not surprisingly, did spike up, but didn't necessarily give us an extreme reading. And here's the 5 period of that, also showing an increase and not necessarily extreme. Here are the pivot levels for Monday's session. If you end up using those, I use these very heavily on a 10-minute bar chart. Here's a daily chart showing how we came down, and this should actually be support. We were above, it was acting as resistance. Well, we now came down below that in Friday's session, and we've actually closed a little bit below this longer term support line. So we lost a lot of positive things in Friday's session. Doesn't mean we can't get them back, but for right now, this is kind of a scary looking chart. Looking at the bottom, you can see we were just slightly below average as far as volume. Here are the pivot points for the month of August, and you have the big ugly red candle over here on the right. Here's some Fibonacci retracements. We also lost some support that way. We broke down below the 61.8% retracement level. We're still above this 50% retracement level at about 4,019, 4,020. We're still above that. So we want to keep an eye on this area. This had acted as resistance on the way up. Can it act as support if we continue to go down? Looking at the sectors, every one of them was down. The one that was down the least was energy, and that was still down 1.17%. Here's the scooter score showing that energy, utilities, and staples, value plays, they're looking the best as far as from a technical analysis standpoint, with communication getting all the way down to 6.6. Here is the sector chart showing how energy is still in the lead, followed by utilities, with all of the other sectors being down since we hit the all-time high early in January. And here is an updated chart of the different indexes since the S&P hit its all-time high. Technical alerts, they're all negative. NASDAQ, 12.6, 12.5, 12.4, 12.3, 12.2, blast off. I mean, my goodness, the only S&P one here is we dropped below 4,100, but we saw a lot of sectors really show some weakness. And the NYSE also showing some weakness as well. We're seeing a little bit of a shift now. The the index that is looking the best right now after Friday's session, and it's even not looking all that great, are mid caps at 68.3. When this gets up into the high 80s, into the 90s, that means we're really positive. We're not there, but this is the best. Then we have small caps at 62.1. Then the Dow, which had been in the lead, it's down to 61.2. The S&P is not doing very well. My goodness, it lost 16.2 technical analysis points in Friday's session and is currently at 52. And the Qs, man, they took a real dump, down over 20.6. So a lot of technical damage was done. So not an awful lot to talk about here. Had a kind of a tentative open, little bit to the downside, and then the chairperson Powell came out, said some things. The market said, we don't like that, and boom, down through S1, S2, stopped there to breathe for a minute, came all the way down to S3, even broke below that, and ended up closing at the low. Could this be seen as some kind of capitulation? A little hard to tell. On a one-day basis, yeah, we probably overdid it, but this doesn't look like a blowout. We're not seeing sentiment all freaked out at this point. Our trend, we switched over negative. The red line has slightly crossed above the green line, but the ADX continues to decline. Arun's not really helping us right now. It's picking up more recent areas that we were in. So yeah, it's showing that buying is going down, but it's also suggesting selling is going down. And so our oscillator was unchanged overall. Breadth, this was quite negative. Volume, look at how this really shot down based on price, I'm sorry. And then volume was also quite negative. The advanced decline ratio also showing some weakness, but still slightly above zero with one of its moving averages with the 39 EMA. Then new highs and new lows, they are looking negative. Accumulation distribution showing some weakness, but still above the moving average. Short term, this is where we saw a lot of the real damage. The rate of change on one day from Thursday to Friday, boom, we went extreme negative. Going back 5 days, also starting to get extreme. And even 10 days back, we're starting to get extreme there. Some short-term fib levels from the March high to the June low, we retraced really nicely here. Now we've been falling back down. We're below a lot of the moving averages that we had been above not so long ago, like one day ago. So this is starting to look a little more scary right now. We're below the 20 period where we had been above the 20 period after Thursday. This is another one-day chart where we shot extreme positive, maybe overdid it to the upside. Well, now we possibly overdid it to the downside with the advanced decline ratio. Stochc RSI, extreme negative. Williams percent R, extreme negative. Force index, getting near the outside lower Keltner band here. So that's looking a little extreme negative, and that's a shorter term indicator. This is kind of interesting. The Swinland trading oscillator based on price and volume, didn't go up, but it, it's kind of flat. And sometimes this indicator has been very helpful to us. Sometimes it leads us astray. It would be nice to know which was which while we're looking at them, but that would make it too easy. But at least for right now, this indicator is holding up a bit better. McClellan oscillator has now dropped below zero and is negative. All of our moving averages really are in a decline with the 20, 50, and 200. Stochc in the short and intermediate term getting extreme negative, where the long term has now gone into a downtrend. Intermediate term, we're dropping below the 50 period exponential moving average. The more important one is the red one here, which is by Monday, it might be at around 4,000. It's at 39.96 right now. Can we stay above that if prices continue to fall? That's a big moving average that a lot of folks use. The Sean trend meter showing weakness. Our PMO has switched over a negative across the board. Our PMO studies starting to look a little extreme with the PMOs that are rising. Buy signals are declining, and those that are above zero are declining. Chaikin oscillator dropped below zero and showed a decline. Chaikin money flow, it's still positive, but showing a lot of weakness. And this could switch over to negative about any time if we see follow through selling. Volume picked up slightly, but is still quite below average overall. The vortex is starting to cross over negative. The red line is slightly above the green line. The summation index based on price and volume continue to be negative and declining. All of our oscillators have now crossed over negative. So that's not really healthy if you're a MACD user or any of the different oscillators out there. They're not looking all that good right now. The BPI holding up, but dropping nonetheless after giving us an extreme positive reading. Ease of movement is showing a decline. Ultimate oscillator declining, money flow decline, RSI, and I probably won't show this chart after this video. I just wanted to show that both with the 14 and the 9 period, after giving us an extreme reading, and when this gets colored in, that means it's an official overbought signal. We've been declining ever since then, and we hit that just at about the time we were bumping into the 200-day simple moving average on the way up. Rate of change, 50 periods after being extreme positive. Don't have to worry about that now. CCI 14 getting extreme negative, as is the CCI 20. It's not quite extreme, but is really showing a downward move. The TTM squeeze showing a lot of weakness right now. And if we see some more follow through, we'll probably see this drop below this midpoint here, and with the bars turning to red. Heiken Ashi starting to look more negative. The Kiki chart still hanging in there positive. Renko added another red box, so that's more negative. 3-line break, also negative. We added a 0 with the point and figure chart, but no signal has been generated. The Elder Impulse system for the SPX is negative, and we've fallen below this moving average, as is the SPY. The SAR continues to be negative, and to its credit, this warned us first. This was one of the first indicators a week or so ago that gave us this sign. Now, sometimes you can see heavy drawdowns with this indicator. It gives a signal, and then it goes against you for a while, and that can make for some real nerve-wracking times. But overall, this indicator, especially when we're trending, tends to be fairly reliable. The go, no-go system is more of a lighter shade of blue. If we continue to drop, it'll probably change back to purple. Long-term, we're below the 100 exponential moving average and slightly below the 200, the 100 simple moving average. We're getting back down into more middle of the rainbow with our longer-term rainbow chart. All of our moving average studies are showing a decline. Special K, it had been trying to turn up, but now is turning back down. The diamonds have switched back to negative. Here's a Dow with a lot of technical damage. The Qs, technical damage. NASDAQ 100, technical damage. The VIX really spiked up because of the real decline that we saw. NASDAQ, damage. Mid-caps, damage. Wilshire, damage. So across the board damage. Where the dollar, it was up 0.29% and is still in an overall uptrend. And yeah, it's probably overbought, but it can stay overbought for quite a while. This chart is showing how the S&P and the dollar are going in a pretty strong inverse direction. So if the dollar's going up, stocks are going down. Gold, you would think this would really be going up. Nope, we were down 1.22%. Not to be outdone by silver, which was down over 2%. Oil came up just slightly to 93.06. And here's the correlation showing they have a pretty strong inverse relationship right now. Bonds, after being kind of hopeful there, they're not really doing all that well these days. Here's our World Bond Index. Could be going back down to this low area that we were at not so long ago. Stocks and bonds, they're more neutral in correlating with each other. What we were kind of hoping for is if bond prices could go up, which means interest rates go down, and stock prices go up, that would be kind of healthy for the market. Well, we're not really seeing anything right now. It doesn't know what it wants to do. Our yield curves, we still have the 10 to the 5 inverted, the 10 to the 2's inverted, the 10 to the 3-month is not inverted, but still ever so close. Tech sector to the 10-year yield going inverse right now. Here's some other fib levels going back to the all-time high to the June low, where we were able to retrace 50%, and things were looking a little better until we hit that 200-day moving average, and we've been really having some trouble as of late. Treasury yields kind of bouncing around all over right now, but overall, they tend to be going up. Our scenarios, not that we're using these to make decisions, but just to show you that they're still on the table for right now. I won't really spend a lot of time going through these, but we want to see follow through based on price, and we're just not seeing that yet pretty much with any of these, but they're still hanging in there for right now. Small caps actually outperformed the S&P slightly in Friday's session. but we're not seeing a spike. It hasn't, this red line or this red chart has not got up to the previous spike that we saw. We want to see this really spike up, and sometimes that gives some support to the S&P 500. The S&P to the 10-year yield looking inverse right now. Here's our sector rotation, still on the table, but showing some weakness, both in the first chart and in this chart as well. The S&P to the 2-year yield also going in opposite directions. So it doesn't look like our 2-year yield has spiked, which oftentimes marks some kind of a short to intermediate term low in the S&P. We could take out this spike if 2-year yields continue to go up. Staples, they were down, and we're still working off of this spike right here. Even though we started to fall down and we're coming back up, this is still a valid signal as long as we're working off of this high spike right here. So what's our outlook then? The technicals are negative, but possibly overdone on a short-term basis. Sentiment is becoming more fearful. We don't have any economic reports coming out. The whole list of geopolitical events. We might see some more follow through because of Friday's session. People go home, they spend the weekend reading things, they look at YouTube videos, they pay attention to their different folks, and then make decisions on Monday, and they may decide to sell. So who knows what's going to happen there, but there may be some bleed over into Monday's session. Our scenarios, we're going with the down scenario right now because of rising interest rates, inflation fears, the whole mess that we've been dealing with here. The technicals are negative, but possibly short-term becoming overbought. We can't really go with an up scenario right now because the technicals are negative. Our scenarios are on hold for right now. Technicals, we're losing some of the moving averages that we had gained back. And we're not necessarily sideways unless you use the ADX crossing below the moving average. But the ADX, it's still above 20 and it's declining, but it has turned negative. So our conclusion then is, no surprise here, the S&P is negative, short-term negative, intermediate-term negative, and long-term negative. So thank you. Have a wonderful weekend. I will prepare the weekly video update as well as the intermarket analysis update. And I hope all of these together will help you to make some good decisions about where we go from here.